In investing in finance, rationality is praised above all else. Because rational decisions are unemotional decisions, and those are the types of decisions that are supposed to make you money. But what if that's not really the case? What if instead of being rational, we should just be more reasonable? And that's the topic that we're going to talk about today. And it's also a topic that Morgan Housel covered in his book, The Psychology of Money. He said, do not aim to be coldly rational when making financial decisions. Aim just to be pretty reasonable. Reasonable is more realistic, and you have a better chance of sticking with it for the long run, which is what matters most when managing money. Because here's the thing, and this was something that was difficult for me to accept myself, and I know it's difficult for a lot of people, especially the type A people in finance. We are not robots, we are people. And that means you can't just block out all your emotions and all the irrational stuff that people do. You can mitigate it, of course, but you can't just completely stamp it out. Because if you try to do that, one day or another, it's going to backfire against you and you're going to get hurt a lot more than if you just accepted that you're a person that has emotions and dealt with it right away. And by dealing with it, I don't mean getting rid of those emotions, but instead accepting them and working with them. A good example of this not related to finance is fevers. And yes, I'm talking about a fever when you get sick. Well, what is the point of having a fever? Why does your body do it? Well, the reason it does it is to fight off an infection. But in modern medicine, how do we look at fevers? We look at them as bad things, right? If you go to the doctor and say you have a fever, they will give you a pill to help reduce that fever. But why would they do that if fevers actually help fight off what the actual problem is? Treatment of fever is common in the ICU setting and likely related to standard dogma rather than evidence-based practice. That's what Howard Markel said, the director of the Center for the History of Medicine. He said these are cultural practices that spread just as widely as the infectious diseases that are behind them. So why does this happen? If fevers are beneficial, why do we fight them so universally? Because medical research does show that fevers fight infections. They are a good thing. But the reason we fight them is not actually complicated. It's just because fevers hurt. And people don't want to hurt. That's it. A doctor's goal is not just to cure the disease, it's to cure the disease within the confines of what's reasonable and tolerable to the patient. So fevers can have marginal benefits in fighting infection, but they hurt. And we go to the doctor to stop hurting. So even though that fever will help us fight the actual infection, we don't want it. Why? Because fevers make you feel terrible. So if there's a pill to reduce the fever, we're going to take it. So it may be rational to want a fever if you have an infection, but it's not reasonable. And that's the difference once again, rational versus reasonable. You gotta go for reasonable. So we all know that finance is devoted to finding optimal investment strategies, right? But in the real world, people don't want the mathematically optimal strategy. They just want a strategy that maximizes for how well they sleep at night. Because once again, we are not just robots. We have these emotions. So we don't want just a strategy that looks good on paper. We want something that feels good too. You know how often we've talked about volatility on this channel, right? Oftentimes in an investment strategy, the higher volatility you have, the higher gains you can get. But on the flip side of that, higher volatility means you're going to have lower lows too. And you're going to go through that roller coaster. And for many people, most people in fact, that's going to make them sick. Which is why not everyone's making a ton of money in the stock market constantly. Because those types of strategies, even though they may be successful, not everyone can do them. Very few people could actually perform them. Because we all know how emotional we get when it comes to money especially. Money, whether you like it or not, to a certain extent is your livelihood. So when you see your money dropping fast, that hurts. It physically hurts. We all know that. And it doesn't make sense to try to separate that completely because it's not really possible. Everyone has their uncle point somewhere. But anyway, Harry Markowitz, he won the Nobel Prize for exploring the mathematical trade-off between risk and return, which is exactly what I was talking about with volatility, right? And he was once asked how he invested his own money and described his portfolio allocation in the 50s when his models were first developed. So he said, I visualized my grief if the stock market went way up and I wasn't in it, or if it went way down and I was completely in it. So my intention was to minimize my future regret. So I split my contributions 50-50 between bonds and equities. So there you go. The guy who won the Nobel Prize for understanding the trade-off between risk and return still did what he thought would feel the best. And this isn't to say that he's emotionally weak or that any of us are emotionally weak because we can't take the ups and downs of the stock market. That's stupid. The smart thing is to realize that, hey, we're humans and again, we have these emotions. So let's work with them instead of against them. See, a completely rational investor makes decisions based on numeric facts, but a reasonable one has a lot of other things going on. You got your spouse that you don't want to let down. You got your kids that you don't want to let down. You got your neighbors and your friends that are making a bunch of money that you want to compete with. See, investing has a social component that's often ignored when viewed through a strictly financial lens. And I can't tell you how many people I've seen make financial decisions just because they talk to a friend. And I don't mean they talked to a friend who had a good idea and they're like, oh, I should be doing that too. It was more like they talked to a friend who said, hey, I'm making a bunch of money in this because I'm a smart investor. You don't even know about this? Wow, dude, that's really stupid. Like, you're losing a lot of money to inflation. And then they go make an investment that they're not really sure about that blows up on them later. Just because they don't want to feel like an idiot. The rational decision was to either not make that investment because you don't actually know what you're doing, or to really study it and be an expert in it before you did it. But most people don't choose either of those paths. They just, try to keep up with what their friend was saying because they don't want to look stupid. Same thing happens to me. I've told you guys that I keep a lot of cash on hand. Not on hand like a bunch of cash in a vault or something. I'm saying in accounts I keep cash. And the reason why is because with the volatility of owning businesses, I know that I need that financial cushion just to make me feel good when things aren't working out so well. And not only feel good, but that cash that I have is used to pay expenses. Now, if I told most people that, what they would say is, dude, you're an idiot. Do you know how high inflation is? That's just eating away at your money. And if I was an idiot, I would listen to them and then go put it in an investment. But that would not be the smart move for my situation. But you can see how easy it is to get influenced by your social circle. Same thing with renting versus buying houses, always a huge debate. You know what the answer is? You gotta do what's best for you. But I've seen many renters get shamed out of renting and go buy a house when they really didn't need to buy a house or wanted to, just because people were telling them how stupid they were and how much money they were throwing away. Anyways, I beat this to death, but the point is that financial decisions don't happen in a vacuum. People aren't rational. They are influenced by everyone else around them as well. Here's another example of rational versus reasonable, and this is a funny one. In 2008, a pair of researchers from Yale published a study arguing that young savers should supercharge their retirement accounts using 2-to-1 margin. Yeah, go on margin. When buying stocks. It said that those investors taper that leverage as they age, but this lets them take more risk when they're young because they could handle it if they blow up and still recover. And they proved that even if using leverage left you wiped out when you were young, savers would still be better off in the long run as long as they picked themselves back up, followed the plan, and kept saving in a 2-to-1 leveraged account the day after being wiped out. Now here you go. This looks great on paper, right? Of course it would work. It's a rational strategy, but it is almost absurdly unreasonable. And why is that? Well, that's because no normal person could watch 100% of their retirement account evaporate and be so unfazed that they carry on with the strategy undeterred. Yeah, if you're being realistic, the day before you get wiped out and the next day you're just back in the market like nothing happened? No, that's not gonna happen. If that was the case, we wouldn't have all these stories of people who sold out at the bottom of a market crash, who also never got in until the top of the next market bubble because they were so scarred by what happened. So these researchers argue that when using their strategy, the expected retirement wealth is 90% higher compared to life cycle funds, but it's also 100% less reasonable because no one's going to follow that properly. And that goes back to what we said in the beginning, right? Don't aim to be coldly rational when making financial decisions. Just aim to be reasonable, because reasonable is more realistic and you have a much better chance of sticking to it for the long run, which is what matters the most. That's what we always say on this channel, right? Stick to your strategy. Whatever your strategy is, you just got to stick to it. And a big component of being able to stick to your strategy is choosing a strategy that fits well with you. One in which you can handle the emotional ups and downs. Because if you can't handle them, it's not your fault. You just need a strategy where you can handle it. And that's how everyone can be successful long term in the market. Another example that we've talked about before on this channel is starter positions in investments. Oftentimes what we do in the macro ops portfolio is put a little bit onto a position before we actually know if it's a great investment or not. We just have a feeling, so we put it on. It's just a tiny little bit. Now, why do we do that? Well, there's first of all the rational side of it where, hey, if we put a little bit in, if it takes off, we're going to make a little bit of money. But there's also the reasonable emotional side of it. The first reason being, if you put a little bit of money into that position, you're much more likely to watch it and pay attention to it versus just having it on a watch list. And that sounds pretty stupid, right? Because if you are 100% disciplined, it shouldn't matter if you have money in the stock or not. You should be watching it like a hawk. But the truth is, and the reasonable thing is, that you won't. So one way to mitigate that is to put a little bit of money in there. Another reasonable emotional reason why you would do that is to reduce your regret. Because how many times have you missed out on stock where you had a feeling and you're like, oh, damn it, I didn't do it and it took off without me. Well, by putting that little starter position in there, you could say to yourself once it takes off, hey, I knew it, I had my money in there, that's great. Even if it's a little bit. And I'm saying it's a starter position because at the end of the year, it's not actually going to contribute to the bottom line. But it does help us preserve that emotional capital, if you want to talk about it in that way. And of course, on the rational side, we could add on to that position too. But the truth is, a lot of the reason why we do it is to manage our own emotions. And that's a good example of not trying to stomp out our emotions completely, but instead working with them in a reasonable manner. Because we know this is how we are, let's do our best to mitigate it and work with it. Here's another kind of funny story. Jack Bogle, the late founder of Vanguard, spent his career on a crusade to promote low-cost passive index investing. And what was interesting is that his son was actually an active high-fee hedge fund and mutual fund manager. So pretty much the opposite of what his dad worked his whole life for. And Jack Bogle actually had his own money invested in some of his son's funds. So what was the explanation for that? Because it's not rational, is it? Well, Bogle told the Wall Street Journal that we do some things for family reasons. If it's not consistent, well, life isn't always consistent. There you go. Even Jack Bogle admitted that he's an emotional guy. And really, Jack Bogle's whole story is very interesting. We made a video about it a while ago right here. A lot of the reason that he promoted index investing is because he knew how irrational people really are. So definitely check out that video by clicking right here, and I will see you there.